Good morning, everybody. It is Tuesday, September 20th at 10 a.m. So it's time for our Tuesday weekly webinar. If you're joining us on YouTube, I have to say that please hit the subscribe button and the like button and the notification button. Many people, more and more people, I should say, are finding us on YouTube. So that apparently is a requirement to say. I know I joke about that every week. But all right, this week we're going to talk about Well, first, let me just do some housekeeping. Let me remind you, of course, that you are being recorded. You are all muted. There is a Q&A that's available at the bottom of your screen, so please ask questions as we go. There is also a chat function, which I think that you should be able to use now. So let's just see. So prior to that, no, that's just for me apparently. Prior to that, there was a regulatory requirement that chat wasn't allowed, but Q&A was for some reason, but it seems to be eased now. I'm sure it's some kind of monitoring. So today we're going to go over our normal format. We're going to talk about some IRA updates, IRA distribution updates from the Slott Group. I think I told you already, but I'm scheduled next week to be in Las Vegas with Ed and his team for a few days. I'm taking a few days before that. So I'm excited about that, and I'll have lots of information to bring back to you. We've got the Changing World of Retirement Plan going, or Changing World of Retirement Planning class that David McKnight created going on right now. We are coming up on class 2 for our Tuesday evening class and finished class 2 for our Tuesday evening class last week. We have a special guest webinar scheduled for October 26th. That's a Wednesday at 6:30 p.m. And that's going to be with Heather Schreiber. Heather is someone I met through the Slott Group, and she is an absolute Social Security expert. So, I've talked to Heather a lot about different client questions and Social Security planning questions. And she really is the main person probably in the country for these for Social Security issues and questions. So Heather's going to join us on October 26th at 6:30. And like we always do, it's going to be kind of just a discussion format. No real presentation. We're just going to talk about Social Security and some of the myths and planning opportunities that are still out there. All right, let's jump into it. So first, let me just get a raise of hands if everybody can see me and hear me. Okay, so raise your hand if you can see me and hear me. Okay, good seeing you, everyone. Today we're going to go through talk about the retirement distribution issues. We're going to talk about investments. It's been a tough couple weeks, and today's not looking any better. This week's not looking any better. Can't say we haven't been talking about this, right? And then I've got just a couple analysts reports, and then we're going to talk about our financial planning topic, which is falling under the investment fundamentals category. So last week we had active versus passive. The week before that we had asset allocation. Today we have understanding investment risk. So we're going to talk about that a bit. So of course, one of the reasons the markets are really struggling is inflation was higher than expected. That came out last Tuesday, right before our webinar. So I talked about that quite a bit, but we're still seeing the issues with that. And of course, along with that, we're expecting significant increases by the Fed this week. So we'll see what happens there, but I don't think there's going to be any surprises. Let's see here. Okay, so let's go right into the Ed Slott updates. I'm just going to share my screen because it helps you folks. And again, if I'm looking around, that's because I'm looking at different screens. I can actually pull this one down here. So just raise your hand for me if you see my screen that says Ed Slott updates, QCD, and the absolute necessity for CWA. A lot of nice little initials. Now, again, we've talked a lot about QCDs. We've talked a lot. They're charitable, qualified charitable distributions. We've talked a lot about RMDs. We've talked a lot about Roth conversions. We've talked a lot about retirement rollovers, IRA rollovers, 401k rollovers, pension plan rollovers. We talked about these things numerous times. However, people still make mistakes. So unfortunately, someone contacted me last week, and they said, "Oh, geez, I did my RMD, or I did my Roth conversion before my RMD. What happens?" Well, unfortunately, when that happens, you have to undo the Roth conversion, or excuse me, the RMD. No, I'm sorry, I was right the first time. You have to undo the Roth conversion, complete your RMD, and then you can do your Roth conversion. So, and someone asked a follow-up. Well, what if I get monthly distributions? Well, that doesn't matter. The IRS wants that RMD completely distributed before a Roth conversion. So if you're getting them monthly or quarterly, you've got to get them all done before you can do a Roth conversion. And if you're getting a quarterly distribution and your last quarter distribution is, let's say, this December 1st or December 15th, it's very, very likely you're not going to be able to get a Roth conversion done. So you've got to know these things. And QCDs are another issue. Some people they think they're doing QCDs, qualified charitable distributions, the right way, and they're not. It has to go directly to the charity. There are some limits. You have to be over 70 and a half years old. Can't be in the year that you turn 70 and a half. You have to already reach that mark. There's a person who said, okay, well, I did my qualified charitable distribution, and they took it into the bank account and then sent it to the charity, and that's not a qualified charitable distribution. So Andy here talks a little bit about qualified charitable distributions and CWAs. So Andy, I believe you've met before. He's one of Ed Slott's IRA analysts, and he writes, qualified charitable distributions are a common transaction these days. I am hearing more and more about these every single week. But all guidelines must be followed to ensure QCD is valid. Recent court cases have exposed the absolute necessity to adhere to the rules, or the donation could be disallowed. So that simply means then you're going to have to funnel it through your tax return, just like you would any other charitable contribution, and you may not receive the benefit that you're looking for that, and then you're going to pay tax on that distribution, of course, because it's an IRA distribution. So for IRA owners, I'm right here, second paragraph, where's my pointer? For IRA owners who are age 70 and a half or older, donations paid directly from an IRA to an eligible charity may be excluded from income. Using QCDs to offset all or a portion of a required minimum distribution is incredibly popular. Up to $100,000 annually can be sent to a charity via QCD, and this is in addition to the standard deduction. However, there can be no benefit back to the taxpayer. No goods or services and this is another thing. People try to get, kind of cute with this. The IRS is really clear about this. No goods or services other than intangible religious benefit can be received in exchange for the contribution. This language is important. Regarding itemized charitable deductions, I'm right here. Regarding itemized charitable deductions, historically, taxpayers have been a little loose with their details. Overstatements and fabrications were, and are probably still rampant. Deductions were taken for more than what was donated and for donations that never even occurred. To curb abuse, Congress passed strict laws governing the reporting of charitable contributions. These rules cover both cash and non-cash donations. How much was given, what was the fair market value of the item, what was the taxpayer's cost basis on the item, and the rules go on. Not surprisingly, most donations need to be documented with some sort of receipt. Officially, this is called a contemporaneous written acknowledgement, a CWA, and it is applicable to all contributions of $250 or more. Ultimately, when a QCD is done, the necessary documentation needed for a tax return includes the amount of donation, the date of the donation, the name of the charity, and whether the charity provided any goods or services for the donation. Remember, no goods or services other than the intangible religious benefit can be received in exchange for the contribution. So I am right here at this since QCDs. So since QCDs, didn't mean to highlight that. Stop it, Microsoft. Let's stop that. Okay. Since QCDs are typically sent directly from the custodian to the charity, verifying the date, amount, and to whom the dollars were sent should be easy. The tricky part is getting the proper receipt from the charity. Even if no goods or services were received, the CWA cannot remain silent on this issue. It must state that nothing was transferred back to the donor. And if the language about no goods or services being received is missing, the entire donation could be disallowed. So in one particular court case, and I told you before, this is one of my favorite parts of the slot updates are these court cases, these tax court cases that address these issues, and they can change things sometimes, right? So because there are a couple different ways that laws are written and regulations are based, and some of them are court cases. So it's always fascinating to me. In one particular court case, all parties agreed that a donation was made. However, the no goods or services received language was missing from the CWA. Despite the obvious donation, the judge's hands were tied. Based on the strict laws, the charitable deduction was denied. Additionally, there was no retroactive fix. This is common too. The IRS often, most of the time, doesn't let you go back and fix it. There are some exceptions to that. But my goodness, but why no retroactive fix? Because the CWA must be obtained by the taxpayer on or before the earlier of the date on which the taxpayer files a return, or the due date, including extensions for filing the return. So once that passed, it's no good. Creating or sending the proper documentation after the fact is of no help. Note that while the court case involved an itemized charitable deduction, the same CWA rules apply to QCDs. Please be careful. It's imperative that QCD and general charitable distribution rules are acknowledged and firmly adhered to. I'm right here. Otherwise, simple acts of kindness and giving can be ruined and tax benefits lost. Well job, Andy. I think when I read that, I just thought that was a really great piece. I know that QCDs might not apply to everybody, but again, it's repetition of these things. I want these kind of embedded in your head, and you don't have to know the answers. You have to know when to ask the question. I hope that makes sense. One thing I learned from my CFP training in education was there's just so much material there that you have to learn, and you have to be ready to apply to this comprehensive exam. And one of the big differences with the CFP designation and something like a chartered financial consultant or even a CPA is you have to be proficient in everything all at once. And I'm not putting this down, but for example, the chartered financial consultant, they might say, well, there's 2 more classes required for that than a CFP. And while that's true, there is no proficiency exam. There is no, 50% pass rate type of exam. It is just simply completion of these classes. So that's a big deal because, a lot of people don't pass that test. And my point is there's so much material that is required for that test that you can't retain it forever. But what I've learned is it's created, that questioning ability. I know, and I remember there's something about that, right? What's required for a QCD is an example, but then that kind of triggers that question, and you go to the Slott Group. I'm fortunate to have the Slott Group as a resource. Somebody like Heather, as a resource. My friend Steve Bobrin, who I always go to with Medicare planning issues. So I hope you gain that through this process, this education process that I'm giving you on a weekly basis and special webinars. And I'm excited. I didn't mention this, but the website is we started the whole development and fact-finding part of it, and we're going to have our traditional website and Attleboro University website, and you're going to be able to go through modules for education. So I'm really excited about that. So, you just want to kind of keep those questions, or have that level of education where you know when to ask the question. So Doug's asking, QCDs can be part of your RMDs. Yeah, qualified. So Doug, a qualified charitable distribution is a way that if you're over 70 and a half, and I know the RMD age is now 72. I know that. But the Congress didn't update the age when they updated the RMD requirement. They left QCDs at 70 and a half. So once you cross that age, 70 and a half, again, if you turn 70 and a half in May, you can't do this in April. You have to wait until you cross that half birthday. I know that those half birthdays are crazy, but an individual can take up to $100,000 and deliver it directly to a charity with the requirements that we just outlined, and you don't pay tax on that because it's a direct payment to the charity. Now, if you receive, Doug, the $100,000 into your bank account and say, well, I'm going to give $50,000 to this charity and $50,000 to that charity, then you've violated the rules and it is no longer a QCD. It's just a regular charitable donation. The benefit of the charitable the QCD over the charitable donation is it doesn't have the same kind of gates to go through to see how much is eligible for tax deduction. That $100,000 can just go direct to the charity or multiple charities if you'd like. And it just, you don't pay tax on that distribution. It's a special allowance within the IRS code. So good answer, or a good question, Doug. Okay. Roth conversions and designated beneficiaries. So this is the slot report mailbag. So this is the question and answer part of this. This is from my friend Sarah Brenner, who I can't wait to see in a couple of weeks. So Sarah got this question. Hi, Mr. Slott. I read somewhere, but couldn't remember where, if a person needs to withdraw an RMD but doesn't need the money, can he convert this RMD to a Roth IRA? So raise your hand if you think that a person can convert a required minimum distribution to a Roth IRA. Nobody's raising their hand. Raise your hand if you know that you think you cannot convert an RMD to a Roth IRA. Good. So many of you are raising your hands. Yes, you can. That's the answer. You cannot convert an RMD to a Roth IRA. I just talked about that because you've got those rules about taking your RMD before your Roth conversion. That's why you have to take the RMD before your Roth conversion, because you can't convert an RMD to a Roth IRA. You can, of course, use that RMD to pay tax or whatever you want to do with it. It just has to come out of the IRA so that the federal government can get their tax. They're a hungry group of individuals. They want that tax. So here's Sarah's answer. This is an area where there's a lot of confusion. An RMD cannot be converted to a Roth IRA. The reason for this is that the tax rules are very clear. She's going to repeat what I just said. I'm sorry. That an RMD is not eligible for rollover, and a conversion is considered to be a type of rollover. The correct way to handle the situation is to take the RMD from the IRA and then convert the remainder of the IRA or any portion of it. The RMD cannot be deposited as part of the conversion. So that question is asked all the time. And it's a big mistake made all the time. So I remember when I first started in the Slott Group in 2012, I guess it was, and I was reading these things, and I really, after a period of time, you think you kind of see these things all the time. People have to get the idea that, these are the rules and these things have to be done, but every single year it's the same things. No designated beneficiaries, the wrong amount of Roth conversions, the wrong type, the wrong, doing the RMDs are done late or wrong or missed or aggregated when they're not supposed to be aggregated. Just the same common thing. That's why I wish however many financial advisors there are in the country, at least in the US, I wish they would all be part of Ed's group so we could just put a limit on these mistakes. This question, my client passed away in 2021. He had an IRA for which he made his, at the time, revocable living trust the sole beneficiary. Nothing wrong with that. He had one son who was the sole beneficiary of his estates. As I read the regulations, I believe the son fits the fact pattern to be treated as a designated beneficiary, since the son is the sole beneficiary of the trust and its assets. So this person is obviously a professional, lawyer, CPA, or CFP, or something like that. As such, I have concluded that the son falls into the category of designated beneficiary, not an eligible designated beneficiary, and therefore has 10 years to liquidate the IRA. My client had already begun to take RMDs prior to his passing. Based on the February proposed IRS regulations, will the son need to take, air quote, stretched RMDs in year 1 through 9 and the balance in year 10? This is where Congress and the IRS has made RMDs much more confusing. And with confusion comes more of an opportunity to make mistakes on the highest penalized, as far as percentage, item in the code. So again, if you miss a required minimum distribution, it is 50% of the amount you should have taken. So when you get into IRAs that are millions of dollars, those amounts get very big. So Sarah writes, Jack, hi, Jack, we agree with your analysis that the trust meets the look-through rules and the son is considered a designated beneficiary. The 10-year payout rule would apply to the trust. That would mean that the inherited IRA would need to be paid out of the trust by the end of the 10th year following the year of death. The new IRS proposed regulations do add an additional twist since the IRA owner died on or after his required beginning date. That's April 1st of the year, after the year you turn 72 currently. The trust does need to take RMDs based on the single life expectancy of the son during years 1 through 9 of the 10-year period. If the IRA owner died in 2021, the first RMD based on this calculation would be due by the end of 2022. I know that sounds very, very confusing. If you have a question about this, you need help, you reach out to a qualified expert. All right. And if you want to, if you have questions about naming a trust as a beneficiary to your IRA, go to our website at outofourwealth.com. I'll show you real quick. I am so excited. I can't wait for this website to be updated. I love our website, but I'm really excited about this Attleboro U. So then go into special webinars. So this is our homepage. You go into events and webinars, you go into special webinars. And right here, it'll populate in a second. This is one of the reasons why we need a new website. We have so many videos up. Should you name a trust as your IRA beneficiary? So this is a special webinar with Sarah Brenner, who wrote that. So that gets a lot of great reviews. This is a lot of good topics in here. So take a look at that. All right, let's get this out of the way. I'm going to stop my share here and read the rest of our webinar. No questions before I move on. So now let's talk about the markets. So I'm going to share with you. I do this from time to time, but I'm just going to share with you the chart that I look at, and we're going to talk a little bit about it. All right, so raise your hand for me if you see something that says Invesco, markets review at a glance. So Invesco is an investing partner of ours. I don't think we currently have any Invesco investments, but you know, this is not a recommendation to not invest with Invesco or to invest with Invesco. This is their material that I rely on and use, so I want to give them the credit they deserve. So this information is as of, let's see if I can write on this, as of September 16th. And you can see here, thank you everybody for letting me know, but you can see here, let's look at the stock markets, right? What we call the equity markets. So this is the 1 week period right here. This is the year to date, and this is the 1 year period. So 1 year, of course, is this time last year compared to this time this year. So roughly September 16th I guess would be exactly September 16th, as long as it's a market day. That makes sense. Last year until September 16th this year. So last week and last year, over the last year, the Dow Jones Industrial Average is down 9.5%. Just the last week, it was down 4.11. Year to date, it's down almost 14%. Holy cow. The S&P 500 is down. Let me just make that a little easier to read. The S&P 500 is down negative 17%. Let's call it almost 18%. And the NASDAQ is down negative 26% for the year. Everything, all these indices were down for the week. Negative 4.11, negative 4.73, negative 5.46. Negative 2.82, negative 2.61, negative 2.72, negative 4.03. It's very difficult out there right now, isn't it, folks? And still, year over year, look at these 1 year numbers. They're down across the board. We had really, really healthy returns this time last year, going even until the end of the year. And then we've just been falling off of this difficult cliff. And it's a tough slog. And I keep telling you that I think, unfortunately, it's going to be this way for the next year and a half. 3 years to maybe 5 years. I'm hoping it's not 5 years, but we're going to be struggling with higher inflation, higher interest rates. And I'm not saying higher inflation from where we are now, right? I expect that I'm hoping that'll come down to a manageable level, but you know, we can't live on 6% inflation. 4% inflation is very, very hard. So I hope we hit around 3.5%, but I'm not sure about that. So people expect this, you know, the stock market, they expect this kind of volatility in the stock market here. So nobody likes it, but they expect it. What people had not expected was this Barclays aggregate bond index as an intermediate bond index. So you can fairly say, let's just say 7 to 9 year maturities, kind of right in the middle, should be limited volatility. So that's down 12.3% this year. So if your allocation, we talked about it before, we're going to talk about risk, if you're in that kind of 60-40 allocation where, you should have 60% in bonds, people say, I know that's impossible to read, and 40% in stock, because as you're getting older, you should have more money in bonds. I don't agree with that. I'm just saying this is what people say. Then suddenly you say, well, wait a minute, I did everything people said I should do. And in fact, that's what my age-based or target date funds did automatically. And I'm getting hammered in there too. So negative 12%, negative 4%, and even the short-term bonds, negative 12, negative 10, negative 13, negative 23. So a lot of negatives. And you'll see here, let me bring you to the middle now here. Let's look at the 10-year treasury. 10-year treasury last week is a 3.45. It did top over 3.5% yesterday. So that's significant. Look at where it was a year ago, 1.34. So remember, the average 10-year treasury should be at about 5.5%. That's really a good average. But what's likely going to happen is I really wish I could draw, but this thing is really thick. It's likely that we're going to go through that, right? So we're going to go, I think, well above 5.5%, probably, hopefully top out at 7 and then level back off. So this is going to be something to watch for sure. We're already seeing, and I'm surprised that it took as long as it did, but we're seeing real estate start to cool. So a lot of things to watch out for. All right, I'm going to stop my share here. All right. So that's the markets overall. Of course, the answer to these issues is not only have a good plan and know what your expectations are for that plan, but asset allocation, principal protection, and account segmentation. So you've heard me talk about it a million times. We are in an unusual situation in our investments where we're sitting on a lot of cash. Very fortunately, I started liquidating positions in February and March, and I just paused. You've heard me say that. I'm looking for the opportunity to start. Well, I have started to buy in for certain people. And we're dusting off kind of things that we used in the Great Recession. I've talked to you before about structured notes and whatnot. I'm not going to go into the details. I'm happy to talk to you one-on-one on that if you'd like. So I don't think you're seeing my screen anymore. So Wall Street Journal, and the Wall Street Journal said, I like to follow Jason Swig, the intelligent investor, and he made an argument for, hey, if the international stocks and economies are down right now, it might be a good time to start buying into those. That's interesting. He says, on just about every dimension, international stocks look and feel miserable. The economic news is dismal. Currencies are crippled and returns have been rotten for years. Things are likely to get even worse before they get better. Europe is caught up in a war that could escalate without warning or limit, as well as an energy crisis that's all but certain to cause severe recession. Fierce energy inflation will also make European manufacturers less competitive. Japan, hobbled by a geriatric population, has also been sluggish for years, and China economic growth is shriveling. You tell this guy's a writer, right? As the nation fights COVID and tries to manage the collapse of its formerly feverish real estate market. Other emerging markets are suffering from the soaring cost of energy and food. So what's he say? Well, it might be a good time to invest, right? So I thought that was an interesting thing. It went, the U.S. market was down about 5% last week, as we saw, just under 5%. This is an interesting take on it. So this is not a recommendation. I'm just giving you one analyst point of view. BlackRock says they're sticking with reduced risk taking. So they're reaffirming tactical views. The new regime of macro volatility is playing out with weaker growth, persistent inflation, and volatile markets. They stick with their dialed down risk stance. U.S. stocks slumped and yields surged on a renewed rise in core inflation, and argued inflation will be persistent and the Fed hiking through the new year, they say. And they said central banks are the main attraction this week. The Fed and the Bank of England are set to raise rates again. We see the Fed hiking 0.75% a third time. So I think I might have shared with you, I was in my bank last week, I do occasionally stop by the branch. We have a credit union, and it's not as easy to make mobile deposits at the credit union. As much as I love those folks, they're just not up with the times sometimes. But I looked up at the TV screen, and 30-year mortgages were at 6.125. That's amazing. It's just so fast. I mean, it's manageable, of course, but it just, it's amazing. So this is the financial planning section. We're going to talk about understanding investment risk, and we catalog these. That's not the index. These videos. So some of you might be just joining us on YouTube, and if you are, please hit the subscribe and like button, and so you'll get notifications. Hit the notification button for upcoming videos. So risk obviously is paramount, and understanding your risk is vitally important. So in preparing for this webinar, I like to show you folks that aren't specific to professionals in what we do. So when I'm referencing a mutual fund or a stock position or something like that, and I'm going to do that today, and any references are not recommendation, they're just examples. But when I'm doing that, I typically like to find resources that you can access. When I'm looking at definitions, I like to use Investopedia, which anybody can access. When I'm looking up ticker symbols and showing you, I like to use MarketWatch, which anybody can access, right? When I was looking for a good risk analysis tool, I saw nothing out there. So now some of you might say, hey, there's this out there. And if you know of something, please send it to me, because I would like to have the resource. So I think I've told you I'm in the middle of a couple of things right now. One is writing a program that's going to be part of the Attleboro University website. And I'm looking for resources like that. And the other struggle I'm having is a direct-to-consumer financial planning tool. But this risk analysis tool I could not find. The other project is a book that goes along with the program. So got a lot going on here. But what I'm going to share with you and walk you through is the risk analysis tool that we use called Riskalyze, and it's widely used in the industry. I actually remember I started using it back in 2010. I think it was, and at the time it was still very new. And when I would call him with a question, it was I can't remember the fellow's name, but the guy who developed it. Now I don't know. He's off on his yacht somewhere, because it's a big program, and it works really well. That's why it's so successful and so widely used. So I'm going to share with you Riskalyze. If you're a client, you've seen this and you've gone through it. But if you're not, it's the tool that we use. And like I said, there's a lot of different risk assessment tools out there. Some of them are just a piece of paper and tell us what your risk tolerance is from 1 to 10. I don't think that's very effective. I have to tell you, as good as I think this questionnaire is, first of all, it's just a starting point. Second of all, it can change at any time, right? And we're going to talk about that a little bit. So let me stop my share here, and we're going to share this screen over here. So you're going to be seeing me look over here. And this is for Frank and Joanna Miller. So raise your hand for me if you can see Frank and Joanna Miller. All right, excellent. So not a real group. This is my Frank and Joanna Miller are based on an actual client, but they're my go-to sample folks. And I did a financial planning process talk with Frank and Joanna Miller some time ago, and I'm going to repeat that. It was back in 2020. I went through the notes just a few days ago. But Frank and Joanna Miller went through a risk analysis, and it's a questionnaire that I like the psychology of, and we don't have time to go through the questionnaire, but if you wanted to go through it yourself, just send me an email. I'll send you a link. It identifies what your risk tolerance is on a scale of 1 to 99. And I like it because it kind of has a speed limit sign. Everybody can kind of visualize that. But I also like the psychology about it, because what you'll see from Frank and Joanna Miller's risk number, they came in at a 40. It showed that they had $1.3 million at the time. That it showed their 6-month comfort zone. So that's over the next 6 months. What are you comfortable seeing in your portfolio? Now, everybody is total amount of investments. everybody's comfortable with this, right? This upside, the 11.5. Yeah, give me all the upside. It's this here, right, that makes people upset. So, and may derail you from your strategy. And that's really what these risk tools are about, right? What's it going to take to keep you on board and meet your objectives? So that's all well and good, plus 11.5 minus 6.9. But one thing I like that this tool does that most others don't is they give you the dollar amount. Well, that's a $90,000 drop in 6 months. How do you feel about that? Now, you might say, well, that's okay. Or you might say, wait a minute, I didn't think about that, right? I don't think that way, as far as percentage tied to the total amount. So that's really helpful. And that helps people kind of check in. So I hope that makes sense. So identifying that risk for an individual, for yourself, is very, very important. But again, it's just the starting point. So we're going to go through. So that's Frank and Joanne. That's where we start. Now, here's where they were. And let me say this risk number. So this was taken, you can see here, June 29th, 2021. So if they were clients, real clients, they would actually be due in June for a reassessment of this. So as part of our financial planning process, you redo the questionnaire. So then we would get an idea, well, if they come in this year, is it going to be higher or lower, and how they feel about risk? We really don't develop a portfolio based on this. Most investment strategists they'll say, okay, we're going to get you to a portfolio that is a 40. It may end up right around there, but we've got a much more evolved process than that. But it's important to know where we are. So if we took this same questionnaire and sent it out today to Frank and Joanna Miller, market's down nearly 5% last week. Bonds are down, what did I say, 12%, 13% for the year. Everything's just falling. Things aren't looking good. Inflation's going to be here with us for a while. I just said it might be a year and a half, 3 years, 5 years. Could their risk number be lower today than it was a year ago? It's likely it would. And that, frankly, that could change in a month because, you've got the market, you have the economy, and then you have an individual situation. What if suddenly, God forbid, Frank's diagnosed with something? Could that change his risk analysis? Of course it could. It has little to do with age, really. So these age-based or time-based portfolios, I think, are they're just generally in the wrong direction. If they're used within segmentation, they can be great. But when you just say, I want to retire in 5 years, so I'm going to pick a portfolio that ends me there in 5 years, that is usually not the way to do it. All right, so let's start with their risk number. We talked about their risk number. Now let's look at their portfolio. So here they came in at 40. Let's just assume we go through it. Frank and Joanna are the same this year. And then let's look at the portfolio that they came in with. And this is one of the things that we do. Please don't make me log in again. Yay. Okay. So this is 100% where these folks were. So this was 401k and an IRA, I think, if I'm remembering right. But they had really common holdings. So an S&P 500 or a Dow Jones Industrial Average, exchange traded funds. We talked about active versus passive a couple weeks ago, or last week, excuse me. A Vanguard long-term bond ETF again. So that when I look at this tells me this person is very fee sensitive, right? So that an index fund, another ETF, another ETF, another ETF. Very, very low fees. That's good. 0.17%. Dividends are around 2.85. That's fine. Potential annual return is 5.47. But you'll see here, look at this band over here. Now, if you remember, what was Frank and Joanna's comfort zone? It was a negative $90,000 over 6 months. And there's a lot of work to get done or to do to get to that number. And this is showing a negative $148,000. So I'm not necessarily saying that, whoa, we got to check this because this is a big difference, right? There's nearly $60,000 difference there. But, and their risk score is 40 and their portfolio score is 57. I might say we've got to bring this down. Our differential of acceptance would be about 5 points on either side. But they might say, you know what, that's fine. I know I answered the questions that way, but I'm okay with this. And that's okay too. Then we would look at, some stress tests. And this is where this tool gets really, really interesting and really good. But I'm going to show you some of the issues with it too. So it shows, well, what if a 2013 bull market were to happen again? What would happen here? The current portfolio would be up $251,000, up 19%. That's good. Everybody wants that, right? Everybody wants the upside. Well, what if a bear market happened again? Just like 2008, what if the bear market happened again? It would be down $293,000. So negative 22%. So well above what they wanted. So again, they might look at this and say, well, you know what? I understand that I'm okay with that. That's starting to push my comfort zone. Or they might say, no way, I can't do that. I could do that in 2008. I can't do it now because I'm just entering or going into retirement. What if the financial crisis were to happen again? That portfolio is down $423,000. So if that happens in the beginning of retirement, that is typically, frankly, if this happens in the beginning of the retirement at $1.3 million, it's going to change their retirement. But this certainly is going to change their retirement. So good to know, right? Look at these diagnostics and know what's in your portfolio. So if an interest rate were to happen again, right, which is where we are. So here is that aggregate bond index. And this is where there's some flaws in this software because this is showing what could happen with rising interest rates, as we saw from May 1st, 2013 to September 5th, 2013. But we're already well past this, aren't we? Remember, bonds are down. This aggregate bond index, in fact, is down. What was that number? I'm gonna jump around in my notes here, but I'm gonna give you the exact number per last week. That was down almost 13%, 12.38%. So we've already surpassed that. Now this is looking forward 6 months, and you could say, well, does this count in the original drawdown, right? The original loss of 12.38, and the answer is no. It's just looking forward. So this is where you've got to have also the expertise and knowledge and experience to apply to this. So the U.S. core index, and because there's, because of the way they're invested, this would be up 3.21%. But again, that wouldn't be a positive growth in this environment. It would likely be down, let's say 8 or 9, maybe 10%. And then if the pandemic were to happen again, the current portfolio would be down 20%. So that's really where we still are. So I think these are good looks. Let's see if there is a question. Gerard, would moving away from a bond fund into individual bonds held to full maturity help mitigate the interest rate risks? So Gerard's is a good question, Gerard. Yes, you could hold individual bonds and you could hold them to maturity. So you could buy a 5-year bond and get whatever yield that's paying today, which is, I think, slightly higher actually than the 10-year, right? So that's part of the economic problem. And then you know that the value of that bond is going to be there and you're going to collect the interest along the way. Yeah, we could certainly do that. The problem is it's difficult to buy bonds these days. It used to be that I would do exactly that. I would buy individual bonds in portfolios instead of bond funds or exchange traded funds because of the risk of the movement of the funds and exchange traded funds. But what's happened is, first of all, the big the fund companies and the SMAs come in and buy them. But also the pricing is way off. So it's more difficult to buy the bonds today, but good question, Gerard. Okay, so that is, the stress test. There's also this great heat map that shows you what securities, right, positions in here are giving us the most swing, right? What gives us the most return? And this isn't always this way, but this one gives you the most potential return, but also the highest amount of risk. Coming in second here is the S&P 500. So no surprises there, right? But there can be surprises sometimes when you look at portfolios. And then if we look at the overview here, I thought this was really interesting, and this is part of what we built out for the financial plan. So remember, their risk was at a 40. They came in at a 57. If we just added principal protection, in this case, it was a fixed indexed annuity, no cost. Just that allocation of 1/3, nothing else, but that allocation of 1/3 to principal protection dropped them all the way down to a 38. Well below where they are. Now, again, I wouldn't stop there. I would do the account segmentation. Account segmentation is designing a portfolio for every part of their life. So we have very conservative funds, including a lot of cash for the first 3 years. And then we make it more aggressive as we go out, because that gives us the ability to invest and have growth, which we're going to see. I'm not as worried about the stock market as I am the bond markets, as you've heard me say. So over time, stock market will recover, and maybe Jason Zweig is right that it's good time to buy into international stocks. Not a recommendation, but that can make a lot of sense in the longer run. If you know that volatility is going to be 10, 13, 15, 20 years out, that works really, really well. So you got to kind of go the extra mile and make sure you're using your asset allocation, using your principal protection that shows you can see the value of that right here, and then using that account segmentation. That's what helps people get through these things. Okay, now I want to share with you. So that was Frank and Joanna Miller. So now let's take a look at this. So I took a look at some really common funds. So we have, and I built this out just for you folks, right? Risk analysis example. So there's no dollar amounts here. I just built in a potential model portfolio, made it really, really simple. The weightings mean nothing other than I wanted them to be in this order: 2025, 2030, 2040. This is not a recommendation or either way to buy or not buy Fidelity Freedom Funds or this Vanguard Core Bond Admiral shares. Just these are really common. These Fidelity Freedom Funds we see all the time. So I wanted to share with you what it looks like, because you might say, well, I heard what Mark said, so I retire in 3 years. So I'm going to put a portion of my money here in shorter term. And then 5 years later, I'm going to need this money. And then 10 years later, I'm going to need this money. And along the way, we're going to add in some core bond fund to help, add some value, stabilize or whatever. And we have a little bit of growth here. So you might think that's okay. And that might be if your risk is at a 62 and the funding works. This actually works where you have these positions. But let's dig in a little bit. So let's look at the Fidelity Freedom Fund 2025. This risk score, this is funds that you're going to need in just 5 years. This risk score might surprise you. It surprised me, in fact, when I looked at it. So that it comes up at a 63. Now, remember, one's the most conservative, 99 is the most aggressive. But you'll see that the S&P 500 risk score is only at a 76. So that's about as aggressive as it gets, right, on the US markets. So this surprised me at a 63, the 2025 fund. The Vanguard Core Bond Federal Admiral share shows a 28. Worst case scenario, it shows over 6 months at 3.56. But let's look at it. And again, you can pull these up on your own. This is from Vanguard's website, the Core Bond Admiral shares. Again, no recommendation either way. I love it because it's a low expense ratio, but is it really giving us the stability we want for our portfolio? So let's look at the return, negative 12.7%. Holy cow. How do you feel about that? How do you feel about if you put, the 60-40 portfolio, 60% of your retirement holdings, your entire nest egg for the rest of your life, into something like this, and it's down 12%. You weren't planning on that because most people don't realize that bonds can fall like that. And are interest rates likely to continue to go up that'll drive these prices down? Yes. So that was interesting to me. So even though a great tool like Riskalyze shows, well, okay, negative 3.56%, I can take that. You got to dig in more. All right, well, wait a minute. What are these year-to-date returns? Because what's going to happen when Riskalyze redoes or continues to update their rear view looking analyses, because that's all these future projections are based on. That fund is probably going to, or that category as a whole, is probably going to look much worse. So you can't just stop there at these sophisticated risk analysis tools. What about the rest of them? How about the Fidelity 2025 fund? So this is from Fidelity's website. You guys can see this as well. I just went in and searched Fidelity 2025 fund. So it's got an okay rating. And most of these, I'll tell you, most of these target-based fund are simply okay. Higher expenses, 0.62. But, year to date, negative 17%. This is these are monies you're going to need in the next 20 or 5 years, and you're down 17%. Year over year, it's down nearly 15%. Not good planning in my point of view. I'll tell you that 100%. What about the 2030? Well, here's your 2030 fund. That looks very similar, doesn't it? Down a bit. And this is one of the problems too, is that they're invested very similarly. They just ratchet it a little bit. So when their holdings drop significantly, they all kind of drop. There's a little bit of difference between the 2030 fund and the 2025 fund, but not a whole lot, is there? So still, when you talk about the drop in your portfolio value is pretty significant. And then the 2040 fund, negative 19%. Now, remember, let's look at what this risk tool, this really great risk tool, and I'm not picking on it, what they said about the 2040 fund. Worst case, negative 16%. They're much closer with that, aren't they? So let's go to 2040. They're 19.6. So I think that even with a great tool like Riskalyze, it's really not showing the true nature. Look how these all roll. 68 score, 63 score, 2030 and 2025. This is the most shocking one. And this one was closer, wasn't it? As far as the worst case scenario, as was the 2025 fund. But this one here, the Vanguard Bond Fund, way off base. Way off base. So you'll see that you can't just rely on one thing. It's like, going back to Social Security planning for a second. I was having a discussion with Heather a couple of days ago, and we were agreeing that, we were talking about the tools and what tools are the best and what she uses and what I use. And, is there a better way? What's the best out there? And she said, they all kind of give the same output. But it's then, and most people, whether it's, individual investors like yourself or other financial advisors, most people just hand them that report and say, this is what you should do. This is how you should collect your Social Security. But you also have to factor in cash flow. You have to factor in taxes, and you have to do all that with your investments too. So I hope this was helpful as far as identifying what your risk tolerance is. If I wish you could just find a tool like this and use it. If you want to see what your risk number is and start there. If we put in your funds, we'd have to spend a lot of time putting your funds in. We can talk about what that looks like. But if you want to just identify your risk score, I'll send you the link. Just send me an email. I'll send you the link. And if you're watching this on YouTube, we're actually going to put the link in the YouTube description, so you can go in and do your own analyses or your own questionnaire. So you should know your risks, know what you're invested in, know your comfort zone, have a plan, and of course, review and adjust it. And the best way that I found to not manage this type of volatility, I'll just say it again, asset allocation, principal protection, and account segmentation. You saw the value of principal protection right here. I think that is, this is one of those things. It's just like being tax efficient. When I do before and after comparisons for people, and I show that just by doing something a little bit differently, you can be tax efficient and you'll have millions of dollars more at the end of your life, or it'll get you through to your end of your life potentially, where you had serious risk about it. If you continued to be in tax deferred and being tax inefficient. So making small adjustments can be life-changing. What I want to point out here before we move on, I think I'm still sharing, is not only did we reduce the risk score, and I didn't mention this before, but we went from a 57 to a 38, which is really a big drop. The potential return, annual return on the portfolio actually went up. So, and we see that. So the individual annual dividend went down because part of it is in now a fixed indexed annuity. It doesn't have a dividend. It's principal protected. It's tied to an index, no dividends though. But the expense ratio, even this is very low, 0.17%, came down as well. So we reduce expenses, reduce risk, and increase potential returns. That's beautiful. And that's a real world example. So again, have a plan, review and adjust, know your risk, know your comfort zone. I hope that was helpful. We will see you next week. If you're on the class schedule, we'll see you tonight. We'll see you Thursday. Have a great week. If you have any questions or comments, if you want to do your own questionnaire, send me an email. I'll be happy to help you. Have a great week, everybody. Take care.